Imagine opening your eyes each morning to a different truth, a reality where your income no longer depends on hours worked, and the familiar jingle of spare change is replaced by notifications of earnings arriving effortlessly. Envision a life where financial independence is not a concept reserved for textbooks, but something you can actually experience. This is not an unrealistic fantasy or a promise meant to tease hope. It is an attainable outcome. Just as the idea of a comfortable retirement varies from person to person, there are countless paths one might consider when planning for the future. Some individuals look into equity release strategies, downsizing assets, or relocating to lower-cost regions. Yet there is another powerful route that rarely receives the attention it deserves. That path is generating income through investment distributions. This approach has the potential to produce an income of $2,900 every single month. Stay with us, because we are about to reveal 3 efficient methods to reach that target. So what determines the exact amount of capital required to make this happen? The answer lies in lifestyle expectations and simple mathematics. While the average person spends roughly $67,000 annually, that figure may not reflect your own needs. Your personal goals, comfort level, and ambitions allow you to adjust that number accordingly. Now, let's add a layer of curiosity. Picture a situation where your assets create dependable cash flow while your original capital remains untouched. It's like owning a self-sustaining engine that continues to deliver value over time. This kind of passive income opens doors to flexibility and freedom. The key is alignment between your vision and your numbers. Take a moment to imagine the future you desire. Once that picture is clear, the calculations become your roadmap toward making dividends the foundation of your independence. In this presentation, we'll walk through how John can realistically reach an income of $2,900 per month, or $35,000 annually. Before diving into the strategies, it's important to understand what dividends actually are and how they function. Think of stock ownership as holding a slice of a business. When that business generates profits, management must decide how those earnings are used. They can reinvest in growth or distribute a portion to owners. In publicly traded companies, those owners are shareholders, like John. When profits are shared, those payments are known as dividends. John receives his portion based on the number of shares he owns. These payments may arrive electronically, by check, or be automatically reinvested. Most dividend-paying companies distribute earnings quarterly. Now, let's discuss dividend yield. This metric shows how much income an investment produces relative to its price. Yields vary widely across companies and change over time. Generally, mature businesses tend to offer more generous yields than younger firms. Calculating yield is straightforward. Divide the yearly dividend per share by the current share price. If a stock trades at $100 and pays $10 annually, the yield equals 10%. This measurement allows investors like John to compare opportunities and balance income goals with risk tolerance. Dividend-producing assets offer the advantage of generating cash flow without selling shares. That means capital stays invested while income continues. For many investors, that combination is extremely attractive. Now let's examine 3 practical approaches that can help John reach $35,000 per year in dividend income. The first method involves covered call exchange-traded funds. These instruments are designed to produce income from both equity exposure and options premiums. They hold stocks while simultaneously selling call options against those holdings. The premiums collected become part of the cash distributions. Call options grant buyers the right, but not the obligation, to purchase shares at a specific price within a defined period. When the fund sells these contracts, it receives immediate income. If share prices rise beyond the strike level, the fund may sell positions at a profit. Several popular covered call funds consistently deliver elevated yields. These products often provide double-digit income percentages. That level of yield significantly exceeds what traditional dividend stocks usually offer. The advantage of this strategy lies in its income reliability. However, it is not without risk. Market declines or expired options can affect overall performance. For John's target of $35,000 annually, this approach would require roughly $280,000 to $310,000 invested. That amount is dramatically lower than what standard dividend strategies demand. Compared to needing nearly $2 million in conventional dividend stocks, this option accelerates the path to income independence. Covered call funds offer a realistic shortcut toward consistent monthly cash flow. The second strategy centers around real estate investment trusts, commonly known as REITs. These companies own and operate income-producing properties such as apartments, offices, and shopping centers. By law, they distribute most of their earnings to investors. Some high-yield REITs offer substantial dividend payouts. Historically, the sector has produced strong long-term returns. On average, REITs have delivered annual returns exceeding 10% over the past 2 decades. Income from real estate fluctuates based on occupancy and economic conditions. While yields can be attractive, downturns may impact payouts. That risk must be acknowledged. At an average return of roughly 10.8%, John would need around $320,000 invested to reach his income goal. Diversification across multiple REITs can help manage volatility. A disciplined approach of consistent investing and reinvestment can shorten the timeline significantly. With patience, financial independence could be achieved within 5 to 7 years. One unique benefit of REITs is their frequent payment schedules. Many distribute income monthly, making them appealing for income-focused investors. The third strategy focuses on dividend aristocrats. These are companies within the S&P 500 that have increased dividends for at least 25 consecutive years. They represent reliability and long-term consistency. While their yields are typically lower than REITs or covered call funds, their dependability is unmatched. These companies tend to withstand economic downturns more effectively. To achieve the same income level with an average 7% yield, John would need approximately $500,000 invested. This is still far less than traditional dividend portfolios require. Spreading capital across multiple aristocrats helps reduce individual company risk. Their history of consistent increases adds confidence to the strategy. Each of these approaches serves different risk profiles and timelines. The right choice depends on personal goals and comfort with volatility. If you're looking for more income-focused investment ideas, watch the video on your screen. It reveals the top monthly dividend ETFs designed to accelerate cash flow.